start recording, and then we're going to start the webinar, and I'm going to start letting people in. Hi everyone, we're going to be starting in a couple of minutes. Why don't you type where you guys are joining from? Can you guys hear me okay?
Hi, everyone.
Hi, everyone. Welcome.
Hello. Glad you're here.
We're going to begin shortly, so I'm just finishing streaming live on Facebook setup, and we'll begin in a couple of minutes, guys.
Yeah, let's give it a couple of minutes before people join in. Hi, David, Hannah. Hi, James. Hi, Vishal. Hi, Yogesh.
Hi, Jen. Hi, Nona.
Are you guys able to see my screen? Or not yet?
Not yet.
Not yet. Okay, great. So let me turn this off. How about now?
Yes.
Okay, perfect. So we can begin. Hi, everyone. Welcome. Today is our first meeting today from a Silicon Valley chapter. We have joined with Ashish and T, a very large nationwide multi-family masters real estate investor network. It consists of many chapters throughout the United States. So we're into thousands of passive and active investors. And today's topic is going to be a very interesting one. Welcome again. We have been requested to conduct this webinar for many years ago, for many weeks ago as well, by many people, because they wanted to know the major difference between apartment real estate, passive investing strategies, and stock market. Which one is a better strategy for wealth building strategies, specifically for busy professionals like most of you are. Some of you have day jobs, work in the Silicon Valley, for example, me and Ashish. So we'll start with introductions, and then we'll have a deeper dive. We have a featured speaker, Sandhya, who is an active and passive investor in many syndications and a former busy professional as well. She was able to escape the corporate world, so I'm excited to learn from her as well about her journey. So let's begin with quick introductions. A little bit about myself. My name is Alex Kolarenko. I'm located in Silicon Valley, live in Belmont. I have a day job. I work in the technology sector for many years. I have tried various strategies in real estate, and over time decided to zero in and focus specifically on syndications and passive investing strategies. Since then, I have been able to actually become an active syndicator and help others along the way to co-invest with us and my business partner, Ashish Sanan. We started the Wealthy Mind Investment company sometime last year, and now helping other busy professionals also to co-invest with us passively into apartments. And having said that, Ashish, why don't you go ahead and introduce yourself?
Sure. Thanks, Alex. Good evening, everyone. My name is Ashish Saran. I'm Alex's partner and co-founder, Wealthy Mind Investments. I'm excited to welcome our guests and all the attendees who have taken time at this point of time after a busy day. So something I would like to share, fast forward to, last year. Similar background to Alex. You started in the tech industry and have been investing into real estate for many years. Typically, a retail type, single family condos and townhomes, and graduated to the bigger deals. And the passion for real estate, from the family background, it grew, as well as understanding the underwriting while working for Merrill Lynch. And we were operating in silos, like, both of us were investing into these multifamilies. And then one day we just, started brainstorming that, why don't we do this together and start helping our friends and, people that were interested to explore these larger deals. So that's where the idea came. And another bigger motivation that we both had was, the stocks were not working out well for both of us. So every time we were putting in money into stocks, we were losing money too. We were making money, but at the same time, we were, losing money too. So anyways, I will introduce T after this, and let's get started.
Very good. Thank you for the intro. T, why don't you introduce yourself as well?
Okay. Hi, everyone. My name is T. Did. I'm currently practicing therapeutic optometry in San Jose. And about 2 years ago, I became interested in real estate investments. So I spent quite a bit of time learning and researching about the different types of opportunities in real estate investing. And starting this year, at the beginning of this year, I decided to focus mainly on multifamily and decided to join Dave Lindahl's personal mentor coaching program. And since then, I co-founded the MF Investment Partners and recently joined Multifamily Masters Leadership Group with Alex and Ashish here, and actively looking for deals to partner in with our investors. So thank you so much for taking time out of your busy day and join us. And with that, back to Alex.
Yeah, thank you. Yeah, so just a couple of slides and more from my side. I'd like to give you my personal opinion about the differences between real estate and the stocks, and then obviously the main presentation is going to be given by Sandhya. So this is not a secret. Real estate has been a true wealth building vehicle. We're not pushing just real estate, not recommending just real estate. There's different wealth building strategies. There's stocks, bonds, but we think that it should be part of each busy professional portfolio. It is a proven method to build wealth. In fact, 90% of millionaires have become wealthy through real estate. And today we're going to specifically talk about the syndication and the different vehicles within syndication and the major difference between passive investing in stocks and stock market and real estate. So what is the syndication? A lot of people are confused. They might be aware of that, but they might not know. By the way, please type your questions in Q&A as we go along. We'll be either answering them and we'll have a Q&A toward the end as well. This presentation is being recorded, so we'll be able to share the recording with you as well. So think of real estate syndication as a group investing. So simply many individuals decide to partner together with an experienced partner and acquire larger properties. So when we talk about larger properties, we typically specialize in acquiring 100+ units. They could be pretty expensive. We're talking about 10, 20, sometimes even $50 million. So for an average busy professional and investor, in order to come up with a down payment of a 25% on such a large acquisition, it becomes a little bit of a dilemma how to do that. So this is how this solved. This particular situation is when a group of investors come together. Typical investments are $50,000 to $100,000, and then we're able to acquire such properties by partnering with other experienced operators that have done this before. So syndication is one of the true easy and affordable way for a busy professional to start getting investing without being a headache of being a landlord. So what is exactly syndication? It is on an individual side and the passive side. There is a sponsor side as well. So as a passive, on the passive side, as an investor, you invest the money. There's very minimal time investment involved after you do your due diligence and research, and we can help you with that. And then you have limited control once that happens. On the sponsor side, this is the sponsor team that finds the deal, that underwrites the deal, that leads the syndication until ultimately the project is sold. During the whole period, they do the asset management and they control the majority of the asset, okay? How do people invest their hard-earned money? Let's just take a quick look and kind of back step for a second. So obviously, busy professional has a variety of ways where they can invest. They can invest in stocks, they can invest in mutual funds, 401ks, cash, businesses, real estate. Some of them are tangible assets, some of them are not, right? So there's pros and cons to both of them. So we'll take a look at both of them in this table that represents all the different pros and cons. We believe that in order to have a diversified portfolio, busy professional should have exposure to real estate, stocks, bonds, and some savings as well. When it comes to real estate, it has a lot of the benefits such as leverage, which many others assets do not. It has amazing tax benefits, which Sandhya will talk about more in depth. It has inflation hedge. It is not liquid though. So when you are investing in syndication, for example, you have to be okay with having your assets be tied up for 3, 5, sometimes even more period of time, right? Stocks are liquid, so you can cash in and cash out. So are the bonds and savings account. So there's pros and cons to every assets. And we again believe that it is important to have a diversified portfolio and have variety of asset types that can that can protect you from downside in the risks. We've seen what has happened to the stock market earlier this year, right? So real estate tends to be a lot less riskier, and it has cash flow component, which is a very tax efficient. I'm not going to spend too much time on that. I'll be sharing this presentation with you as well, but think of tangible assets and paper assets. So again, there's pros and cons. Paper assets can be very liquid, but they can be volatile. At any given point, stock market could drop, or individual stock could drop 20, 30, sometimes 50%. Company can be wiped out altogether, as we've seen with Enron and other companies. Tangible assets, they're real assets. They're inflation hedge. You have more control. You can utilize leverage. You can finance that, but they're liquid. There is higher transaction costs. And entry point, sometimes you need a lot of education. All of us in this panel have taken many classes, and we have continued to do so by educating ourselves, because the laws changed, and this is a very dynamic environment. We actually do, with Ashish, currently have an active offering. It's a portfolio of 12 properties, 12 apartments. It is 506C offering. We're able to have a couple of investor spots left. So if anybody is interested, please reach out to us and we'll be able to share more details with you. These particular 12 properties are located in 3 different states. So you gain instant diversification by partnering up with us. This particular offering, the minimum is $100,000. We're able to take exceptions on one-by-one cases. So if you have a strong interest, please reach out to us, and we'll be able to provide more information for you. Projected returns are very different for stocks versus real estate. Real estate obviously has a cash flow component of it, which a lot of stocks do not. Some of the bonds do. The biggest difference between stocks and real estate and even bonds is, again, is tax efficiencies. The law is written in such a way that a lot of wealthy individuals, for example, know how to utilize and leverage different tax strategies to take write-offs. So the cash flow component that you're receiving distribution-wise will reduce or completely eliminate your taxes during the whole period. So please reach out to us, consult with your CPA. We'll be happy to provide more additional information for you. I'm not going to spend too much time on projected returns. So we already have enough of introductions. I'd like to pass this on now to Sandhya, who is our featured speaker, and she'll be able to provide more information about multifamily stocks, as well as different strategies that she was able to implement. And she has received already a tremendous success with apartment investing. Sandhya, please go ahead and begin your presentation.
Hi, everyone. Thank you so much, Alex, Ashish, and Ty for having me here. It's really wonderful to be here at a meetup to discuss one of my favorite topics, which is investments. But let me start with my background. Like most people here, I also have a high-tech background. I have a bachelor's and master's in electrical engineering, and I worked in a high-tech company, Fortune 500 company in Dallas. I've lived in Dallas for about 30 years, and I also got my business degree because after attending many technical meetings, every time I found that the business folks were making all the decisions, and I didn't like that very much. So I decided to educate myself on the finances and see how they make their decisions, and pretty soon started directing programs. They were like $80 million programs with $28 million in budget. So I really liked the numbers, and I liked being able to work with a variety of people. But one thing that happened was I also enjoyed, therefore, with my MBA education, investing in the stock market. And one thing was every year, come April 15th, I had to pay a lot in taxes. And I did not like having to pay quite so much in taxes, especially with short-term gains from stocks, etc. The other thing was in the corporate world, I also had to spend a lot of time at work, and my schedule wasn't my own as much. So I had to pretty much answer to the bosses if I wanted to keep up with the career. So I found that I didn't have flexibility, and I really love to travel. So that's a picture of my family taken a few years ago when we were in Iceland. And so work-life balance was also a priority for me. And I wanted to start diversifying my assets into something else that had some tax advantages and would provide an additional income. So going on to the next slide, that's something. So one of the things I want to point out is, and whenever we think of the stock market, we think of things like volatility and risk. And I want to ask anyone here with a full-time busy professional job, what do you see as volatility and risk with respect to your own job, right? How secure is your corporate job? I know a lot of jobs, especially in the travel industry, have been affected by COVID. So who knows what's going to happen next year that could affect it. So, you know, your salary, your benefits, these are all great things to have, and you assume you'll always have it. And of course, your pension and your retirement plan, see that big bag of money you see there in that slide? You assume that you have it always, right? And one of the things is that could very well change. So what do I mean by flexibility? Do you have the flexibility to quit your job today and live on the beach for a month if you want to and still be okay? Well, maybe, maybe not, right? Depending on what you do for a living. So that brings me to my next point of what is called earned income. What do I mean by earned income? You get your income when you show up to work. You don't make an income when you don't show up to work, right? So that's earned income. You're trading your time for money. And like I said, your expectations of your nest egg might be like this, because like me, you know, I used to work for ages, like 15 years in the big Fortune 500 company based in Dallas. And I thought I had this really big retirement account, right? Well, guess what? One day, if the stock market plunges, I suddenly lose a big percentage of it. And I don't have a say in where I can put that money, right? It's always a very limited set of stock funds, mutual funds, maybe a little bond funds or income fund kind of choices. So you're not able to as easily diversify into something as fun as real estate with your regular retirement money, right? Unless it's with a previous employer, in which case you could take that out and you could roll it into an IRA, like a self-directed IRA, or a solo 401k in some cases, if you have a business, and then you get more flexibility. Otherwise, you're pretty much held to the mercy of Wall Street. So let's go on to the next slide, Alex, where, you know, let's see how that nest egg is doing. Okay, so my biggest inspiration is Warren Buffett, which is, if you don't find a way to make money while you sleep, you will work until you die, right? So how can you make this into a reality? That was my big question. How can I make money while I sleep instead of only making money when I show up to work? So if we go on to the next slide after this, so you see that magnifying glass and that tiny little bag of money? Yeah, just like that overnight, because the stocks plunge, your retirement savings could take a big hit. So That's why I say diversification is very important. So how do you prevent this from happening? And how will your stock portfolio change or be affected in 2021? That's the question that's hidden behind that picture. So if anyone here thinks their stock portfolio is going to be just fine in 2021, I would like to for you to type something in the Q&A saying, yes, my portfolio is going to be just fine and unaffected next year. And I wanted to speak to those folks about that. So going on to the next slide. So what do we know about the stock market, right? These are liquid assets, which is great if you really needed money desperately, right? You can immediately sell your shares, whether you lose money or not, you can still get your liquidity out, right? Which is something you don't have in real estate. But that's probably one of the very few benefits of the stock market. In general, you have no visibility to the decisions being made, right? Like, what are the odds you can go speak to the CEO of the company in which you have a stock and say, I don't agree with your decisions, right? And a lot of it is dependent on the whims of Wall Street, and it's very unpredictable. So a company could make a ton of money and do really well, and their stock could still slide. Do you know why? Because they didn't meet some analyst expectations or some strange phenomenon like that. Or some country like China, they're dependent on China for their business and there's things going on there, right? And so that could affect your company stock, even if the company is doing really well today. And then who knows about Tesla, right? How many of you predicted Tesla was going to do what it did from 2019 to 2020, right? I mean, the company's losing money, but look at its stock. So great if you bet on that. But in most of our cases, it usually happens the other way around, right? So the stock market can have reasonable returns long term, but it's very volatile. And it's almost like a gamble in so many cases, right? Who would have bet on Tesla? Just like I said, you know? So there are no tax advantages as well from being in the stock market, like Alex said. So I always recommend a very diversified portfolio, but keep in mind, I'm not a financial advisor. Most of this is my own opinions. I'm not giving you any kind of legal advice or CPA kind of advice. You should always consult with your CPA. But as far as I know, the stock market investments don't give you any kind of tax advantages. So Alex, we can go to the next slide and talk a little bit about our real estate and specifically multifamily investing. So again, every rich person I know had something to do with real estate as an investment. And I think it's really, really recession resistant asset. So I have many deals in which I'm passively invested. I also have a couple of deals in which I'm on the active side. And I see my collections at the apartment where I asset manage over the last several months. And we haven't had such a big dip. In fact, August and September were some of our biggest collections to date compared to the same time a year ago. So a lot of the stimulus money definitely helped. But the first thing people are going to try to pay for is a place to live, right? If you think about it, before they go out and do other things, if they can't afford their home mortgage, they still need a place to live. So if you choose the right markets, apartment investing makes so much sense as far as a more risk-adjusted returns for your asset. Cash flow is another big reason we invest in apartments. Like I said, a big portion of my investments are actually passive investments, which means I basically vet my sponsorship team, I look at the location of the deal, I wire my money, and then I'm done. So I literally get money while I sleep and I get cash flow. Most of my investments, they pay quarterly. Some of them are monthly, and it's really nice to get the cash flow because if you set a goal for yourself, like I need $10,000 a month as an example in cash flow, you know what kind of an investment you need to make in apartments, and it's much more likely that you'll get it from the apartments than from a dividend stock because it's very unpredictable when you depend on something like the stock market. And if you looked at any of the charts lately, you can see that we're at an all-time high over the last, I don't know, we've had quite a ride over the past decade. And I think we're in for some level of slowdown for sure. The other big advantage of multifamily is this thing called forced appreciation. What that means is, if you think about single family, right? The neighborhood where you live, your house and the house next door, the houses on your street, they're all probably going to be about the same cost per square foot, right? So your neighborhood kind of sets the price for your house. Now imagine the same thing, but it's multifamily. So it's a set of high-rise apartments or two apartments right next to each other, 100 units, 200 units. Well, if one apartment is operated more efficiently, by that I mean the income is more, right? The revenues are higher, the operating expenses are lower, so that the difference, which is your net operating income, is higher for the apartment that's operated more efficiently. Well, then the price of the apartment, the value of the apartment is greater. So you're forcing the appreciation, you're forcing the value of this apartment up by operating it more efficiently. So when you invest passively in an apartment deal and you trust this operator to operate it more efficiently, the price, the value of this apartment that's operated more efficiently is going to go up. And that's what's going to give you a better return on investment, even if the one right next door to it is not being operated just as well. Your apartment's value is not dependent on the one right next door to it. So that's what we mean by forced appreciation. And that's what makes multifamily so different from single family. Because anytime you mention the word real estate, people are thinking of realtors and, you know, single family homes, etc. You know what a headache it is to take care of single family rental? Every time I considered it, I was like, oh no, the last thing I want is a phone call on my Thanksgiving dinner to say that there's a toilet leak, you know? So that's why I always stayed away from single family rentals. Now, a lot of people like the income from a single family rental. They say, oh, I just buy the house down the street from me. And, you know, after all expenses, I make $300-400 a month. That's great. But guess what? When that tenant leaves, you get zero, right? You get 100% loss of rent till you find another tenant, go through background checks, vet them properly and get them. And even if you employ a property management company to take care of that for you, unless you have a really large portfolio, it's hard to justify that expense and make some money. So that's why we love multifamily, because you get the economies of scale, you get the hands off because there's always a third-party property management company. And lastly, it's a non-recourse loan. What does that mean? So I have signed on loans for $30 million, $12 million, $8 million, etc. Well, my net worth isn't $50 million, but I can still sign all these loans. And it's non-recourse, meaning they can't come after my home or my personal possessions unless there's a bad boy carve out. So non-recourse is a wonderful thing. It allows you, it's like the system is set up to allow you to borrow more and more money. So today you see how low the interest rates are. It's like the entire system is made for you to keep borrowing money and investing in these apartments at these low interest rates. So with careful vetting, you get much better risk-adjusted returns in apartment investing than in the stock market. How are we doing with time, Alex? Are we okay? Just let me know when there's like a few minutes left. You're muted, so I can't hear you, but just let me know. If we're like 2-3 minutes.
Sorry. Yeah, we're about 10 minutes, 15 minutes. We'd like to have at least 15 minutes from Q&A. So please, if you have questions as we go along, I tend to talk fast. I know that. Sandhya is doing a much better job. So if you could please type your questions in Q&A, we're happy to actually answer them live while we have all four of us. We're happy to connect offline as well, but please don't be shy and type your questions. Thank you. Please go on.
The other thing I wanted to mention was that multifamily is long-term and it's not a liquid amount. So I always recommend folks, before you start any type of investing, multifamily, stock market, et cetera, have 6 months of expenses saved in a very liquid form first before you venture into this. And again, this is not meant for a newbie with zero money. This is more for, you know, accredited investors, but certainly at least halfway there kind of investors who've got a nest egg, who've got some at least 6 months of living expenses and a decent income for the busy Silicon Valley type of professional. The other reason that I like multifamily is I get monthly reports and I can ask sponsors what they're doing. I can understand the business. I can see if I like their strategy and how they're going about it, and certainly compare reports month to month and learn the business even more. If you want to get active, you know, passive is a great way to learn the business, like practical training, if you will, from your book knowledge before you jump in and decide to get active yourself. So there are just numerous benefits to multifamily. I think I have another couple of slides. Alex, we can go on to the next one. So these are my results right now. So 14 months after joining a mentoring program where I got most of my education, between my tax savings, earnings, etc., I was easily at $250,000, and I worked only part-time on this real estate. I had other commitments, and so less than 50% of the hours of a full-time engineering job. So I didn't just get financial freedom from real estate, I also got freedom of my schedule to do what I wanted when I wanted, because I get to pick my hours when it comes to real estate. And there's enough income from having worked in the corporate world for a while and having all that money that I was able to invest quite a bit of it passively. Income stream was a huge plus. So we could go on to the next slide. I can tell you about how to contact me. That's my website. So if you want to visit my website, put in your name and email address. We can certainly continue the conversation. But one of the things I always recommend is to take action. So whether doing nothing is also an action, just don't forget that. If you just listen to this webinar,
The
go away,
choice.
or go somewhere, it is definitely a choice that you are making to do nothing, but at least do nothing after you've learned about the benefits of multifamily and you're making a choice about it, right? So the other thing is diversification, as Alex has mentioned before. Think about what the stock market is going to do for you the next 12 months and see if this is a good time to have an overall financial plan and diversify away from it to get some of the benefits of real estate that so many people make money from. And we can open it up to Q&A at this point.
Okay, very good. So actually we do have a couple Q&As pouring in already. So let's go ahead. T, do you want to give us a shot?
Yeah, so thank you so much for all that information. Jennifer Lynn asks, what is the minimum investment?
In most investments, it's at least $50,000 is typical. And some of the ones, the larger ones, like what Alex mentioned earlier, it's 100,000. But generally, you want to have about 50,000. There are some smaller deals that could take smaller amounts. But.
Yeah, this is what we've seen all across, usually 50 to 100K. Believe it or not, there are some experienced deal makers and sponsors that have minimums up to $500,000 or even more. So once a sponsor has a very significant track record, they do not prefer to take smaller dollar amounts. So we've seen some sponsors that have even significantly higher dollar amount, but typically it is a 50 to 100K. Just to emphasize what Sandhya was saying about the accredited investor, when it comes to real estate investing, passive investing, apartments, we want to make sure that you guys have enough liquidity as a busy professional. You are diversified, you have savings accounts, you have money in the stock market. So this is in addition to what you already have. We're just recommending you to take some money away and diversify into syndications and passive investing. We were out the operators. Sandhya is an operator. She has active deals every now and then as well. She is based in Dallas. All of us like Texas. Texas has been a great multifamily market as well. So that's our job. We basically vet out the operators, we find the deals, and when we do find the deals, we're happy to share them with you. In fact, I was sharing with you one of the deals that we currently have. It is a portfolio deal, but if you'd like to get in touch with us or with T, I'll be sharing the contact information of everyone who is on the webinar. Please schedule the call with us. We're happy to share what we know, what we already learned, and we continue to learn and evolve. Is there another question, T?
Yes, there's actually a few questions.
Okay, perfect.
Okay, so the next question by an anonymous attendee asks, do the sponsors charge a fee for managing the assets?
Yes, they usually have an asset management fee of 1 or 2%. Some sponsors also charge an acquisition fee up front for all the weeks and months they took to find the deal, vet the deal, etc. And then the other kind of fees that sponsors charge is at the end when they sell the property. There's a certain split that goes to the sponsor versus the passive investor. It could be 80-20, 85-15, could even go up once they reach a certain return. Like let's say they doubled your money. Beyond that, they could even take it down to a 50-50 split. So that's what we call a waterfall structure. So there are several different fees. So it's very important when you invest in a deal to understand the fee structure. And mostly I would focus on what is the return that you want for yourself, right? I would focus on that first and say, does this deal meet that criteria of the return that I want for myself? And then the other question to ask is do the sponsors also have money invested in the deal, and
Yes.
how much do they have in it after they take their acquisition fees? So when the deal is in progress, right? The deal has been closed. Now they're managing the asset. How much money do the sponsors still have invested in the deal? Do they have at least the minimum like anybody else, like me, the passive investor? And in terms of moratorium and foreclosures, et cetera, yes, there's probably going to be some deals that were not doing that great to begin with pre-COVID. So I would expect to see some foreclosures to come through, some deals in forbearance, et cetera, that might be good bargains, but will require some work for the person to be able to turn this around to a profitable deal. Because the reason they're in forbearance is because renters are not paying rent, or in some way they're not getting the collections to be able to pay their mortgage payments, et cetera, right? So I do expect to see such deals, but you want experienced operators with a proven track record to take those on, because it's not for the novice to take on a struggling deal and to be able to turn this around. So definitely ask sponsors for their past track record. And if they don't have it, like everyone has to start on a first deal, make sure their partners have that track record, because that's what you want. You want the whole team to have a little of everything, so all bases are covered. So that's a good way to vet sponsors. And if you want to come to my website and put your name and email address, you can get my checklist to vet a sponsorship team. It does not mean you will get any future emails from me. You can certainly say, this is it, I don't want anything else, and you won't get any other emails. As far as the next one is stocks, you also don't have any say in the management. You don't have any say in how the properties actually run, but you do have the right to question someone. So for example, if you invest in Alex's deal, right, and you get a monthly report and you have questions, you just email Alex and he's going to reply to you. He's going to tell you what he knows about it, or if he can't answer it right away, he's going to definitely find out the information and answer it for you. So you have a direct line typically to the sponsor who raised money from you, rather than, you know, a stock market, right? Any stock, any publicly traded stock. So that's the advantage. Also, this is a hard asset. This is an actual building. You get to go see it if you're in the same city, etc. How do we know the property is managed optimally? Well, usually that's one of the questions, or that is answered in a webinar. They tell you who's managing the property. They tell you their history with the property management company. And they would also give you monthly reports that gives you a pretty good indication of how the property is doing. So you attend the webinar, it gives you certain projections. You get monthly report, you can kind of track it and say, oh, what's going on with occupancy or collections or bad debt, etc. Usually they attach to their investment summary, they give you the financials as well, and you can certainly ask for it. How can we see how much return will come quarterly or monthly? That's a core. Each deal is different. It's like a different business. So you will have the sponsors tell you that in the upfront webinar, and you can track that when you get your reports. Where can I liquidate my investment? Any penalty charges for withdrawal? Typically in real estate, you are planning for your investment money not to return to you for the duration of that particular deal, and every deal is different. So I don't want to throw out a number, but you should at least plan for not getting your principal back for about 5 years. So this is a longer term investment. There are some deals which promise a certain amount of capital back in a shorter amount of time, etc. Every deal is different. So you want to ask your sponsor to whom you're discussing the deal. Like Alex, in this case, you would want to discuss the deal that he is presenting, the specifics, because every deal is different.
Right. Yeah. Usually just plan on 5 years minimum. That's what I tell people. Sometimes we do exit earlier than that, but if you do not have 5-year horizon, you should not be looking into this at all. Because again, this is illiquid investment. There is risk involved. Not every asset performs. Some of them overperform, right? We're going to talk about the IRRs and numbers and this and that, but if you do not have 5-year time horizon, you should not be looking into this at all. You should be diversifying, maybe looking into savings, looking at the stocks. So this is for somebody who has the time horizon, who is able to wait it out, write it out with an experienced team with us. I've done a lot of syndications myself as a passive investor before I jumped in and started helping others along the way. And some of the deals I'm holding 3.5, 4 years, even though the projections for 3 years. Some of the deals I already been exited at less than 2 years, even though the projections were 5, because they were able to execute on the business plan, right? And you have to be okay with that. So that's a very important point. Thank you, Sandhya, for explaining that. So what are the returns? Do you want to take that too?
Sure. Again, the returns vary by every deal, but on an average, in a 5-year period, you should definitely get 70, 80, 90% back in these times. I know in the past, you could have doubled your money in 3, 4 years, etc. But I don't know if deals are performing quite to that level today. But certainly 5 years, 70 to 80% average return, overall return is definitely reasonable.
Sure. Yeah, we're targeting anywhere from 15 to 20%. It is harder, like Sandhya was saying, to get to the doubling your investment. You have to find a really good deal with an experienced operator to get to these return levels, because let's face it, we also had a very good cycle. Right now, there's some discount. There are some operators that are underperforming that bigger operators are able to find and basically take advantage of that. But we're targeting 15, 20%. Remember, these investments provide distributions. That's the beauty of it. Out of 15 to 20%, you might be getting 5 to 10% annually distributed to you while you're holding this asset, right? So that's the beauty of passive income and diversification, is that you're able to collect the cash flow. The operator team is sharing the distributions with you. They have a skin in the game. We only invest in operators that have the skin in the game. And you're collecting the cash flow during the whole period, which is very many times very tax efficient. So you pay 0 taxes on it. That's the beauty of real estate and passive investing. We don't have time to go over in-depth details how we do that. We have some webinars with tax professionals, because there is a lot of tax benefits such as depreciation, amortization, and others. But this is something that we can provide more information. Go ahead, let's continue. We have a couple more questions.
Yeah, the benefit of depreciation for sure is something you have to consult with your CPA, because every case is so different. So what I can get as a depreciation write-off may not be applicable to you. So every situation is different. So
correct.
Average IRR for deals that I have closed, liquidated, or gotten returns, it's in the teens all the way up to 20% has been the typical return I've received. How can you use debt leverage in a syndication like you can in just owning 100% of the real estate and using the bank's money to invest in? Well, because you put a very small percentage down, right? So relative to the value of the property.
Yeah, so for example, so let's say we're buying a $50 million property, right? Commercial real estate, you need at least 25% down payment, right? For individual busy professional, that becomes an unaffordable solution, right? That's a significant chunk of money. And that's why all of us love the syndication model, where we partner together collectively as a group. We're able to pitch in and buy cash flowing assets by partnering with experienced operators, right? So again, typical investments are 50 to 100,000. Some people do invest 250 even $1 million. We've seen this before as well. But this becomes an option for a busy professional to acquire such assets that they're not able to acquire on their own. Ashish, are you able to find any questions on Facebook? We're streaming as well. Do we have any more questions?
We don't have any questions on Facebook Live at this point. And we've answered all the questions in the Q&A as well.
That's excellent.
I'm going to add some flavor to the IRR question that was asked earlier.
Yeah.
Well, some of the deals are, construction projects, where the IRR is significantly larger. than
Higher.
high teen or mid teens. And these are high risk deals and high rewards. So typically I have seen that, you double up your money much faster and your money grows much faster with that. So during COVID, we are not bringing these deals to our investors for, obvious reason. There is a larger risk here. There's a lot of uncertainty there. And before you even see any cash flow, it will take some time to build the project and then, rent it out. And then, you will only get some cash distribution, maybe 2 to 3 years down the road. So those are some of the projects that we have invested in past, but currently, and others can also chime in on that, those are not the projects that currently we are focusing under Wealthy Mind Investments.
Yes, there will be a replay. Thank you, Ashish. Apartment real estate investing is not the only game in town. There is storage units that are available. Some people invest in mobile homes. There's people invest in hotels, as well as retail space, nursing facilities, and things like that. All of us are focusing on apartments because typically during recession, people do tend to downgrade and downsize. If they own a home or if they own a large apartment, they still need a place to live, right? So we think that multifamily is probably the most resistant and resilient asset during such a downturn. In fact, we are tracking the rental collections in all of the properties, and for the most part, they're all performing really well. Now, the location for the properties and apartment is very important. For example, in San Francisco and Bay Area, if any of you are familiar with real estate market, we see a lot of people leaving. We see a lot of people moving from high expensive places to somewhere else where it's more affordable, right? In fact, San Francisco Bay Area is experiencing 15 or sometimes 20% drop in rental rates. But we do not invest nor recommend investing in apartments in such high expensive markets. We're staying away from San Francisco Bay Area, from Los Angeles, New York, Boston. We're looking for cash flowing markets such as Dallas, Texas, such as parts of the Florida, Carolinas, around the Charlotte area. So we were actually closing on a deal in Tempe, Arizona as well. So we are looking for the trends, right? We're identifying and kind of anticipating where the price to rent ratio is still reasonably well, where the prices are not as high, where the business and conditions and landlord conditions are very friendly for landlords, right? This is a very important factor. It is sometimes very difficult to evict anybody in such expensive and anti-landlord friendly states. I think we have another question. Do we have any?
That's a very important point, actually, Alex. What Alex just mentioned regarding landlord-friendly states. We prefer to invest into states which are landlord-friendly, not tenant-friendly.
Yes.
Red states. And someone has a question about local Bay Area meetup. I think we've gone virtual because of COVID, but otherwise, I believe these guys have.
Yes, we actually did start one pre-COVID-19. We have a location in Santa Clara and Silicon Valley, and hopefully the COVID-19 situation is going to improve soon, and we'll start meeting up in person. We'd love to meet up with any of you who are local. Please feel free to reach out to T, me, or Ashish. We can grab a cup of coffee without the masks or with the mask. Depends on your guys' preference. We are local. We'd love to help. We've gone through a lot of learning curves on our own. Again, we continue to learn. And let's face it, real estate is a team game. You need to have a team around you. Nobody knows everything. We're not the experts. We think we know enough to help you get started. We feel like we have a track record, but we can connect you with the CPAs. We can connect you with appraisals, agents, attorneys, or any market that you're looking for and interested in. We're happy to help you to get started investing and getting started in your real estate investing journey. Are there any other questions? Yes, there will be recording.
And one of the things that we are happy to share with you all is that how do we evaluate deals? As Sandhya pointed out earlier, that you can get that list. We are very open to share that. How do we evaluate deals? How to look at the numbers? How to evaluate sponsors? And some of the very hard questions, which sometimes people don't know what to ask. What do you do? How do you mitigate risk? Like one of the questions I was looking at is, what happens if the renters, they stop paying? How do you hold on to the asset? How do you mitigate those risks? So those are some of the things that we look at deeply as to how sponsors, how mature they are in mitigating those risks and sail through these difficult times.
Correct. Yeah. So being able to ask the right questions, a lot of you might not have started yet, and looking into potentially first deal, it is scary. It is uncomfortable. We've been there ourselves. We do have a checklist as well that we're happy to share. We vet out the operators. That's our job. Before we open such opportunities to our investors, we do a thorough job of making sure that the deal makes sense, because end of the day, we do invest our own funds. We have a skin in the game. I think it's important to know that for you guys, and being able to have a comfort level and answer any questions that you might have, because end of the day, this is a 3 to 5, sometimes even longer time frame relationship. So we're going to be working with you through the whole period and provide updates and give you insights on the property and the business plan. So we're going to have to be comfortable working with each other. I think we have a couple more questions. You can go ahead and contact us about the checklist. Sandhya has one. We have one as well. So please reach out to us, and we're happy to share that with you. Are there any documents available on your website, or you can contact us directly? We do have a free report available on our website at wealthymindinvestments.com. If you'd like more information about our track record or a checklist, please contact us, and we're happy to share that with you. We believe in transparency like everybody else. This is a very a serious business. We're talking about significant dollar capital amount when you're partnering up with us, and we want to absolutely be sure that you're comfortable working with us.
Yeah, one thing you want to avoid definitely is buyer's remorse. So you want to get to know your sponsors really well.
Correct.
Think about how much research you do before you buy an appliance or a car. This is a huge investment. Make sure to do your homework thoroughly. Don't feel rushed, and know the people well, vet the sponsors well, make sure they have experience in that location. So, the question that came up regarding the tenants, if they don't pay, how are you going to evict them? That's an easy question to answer, because it depends on the experience of the property management company you use, how familiar they are with the laws there, because we had a small time window to evict tenants. We had 4 non-paying tenants back in June, but we got the tiny window of opportunity in August, and we sent letters to them every week to say that they don't get to not pay their rent. They just get to defer it by showing a good reason that they lost their job due to COVID, and that's why they're unable to pay it. Because one guy had this huge big screen TV, another guy bought a brand new truck. So those show that they didn't use the stimulus money correctly. And we made them aware, our property management company made them aware that they cannot get another apartment later when they vacate this apartment, because it will be on their credit. And we told them, if you vacate by the end of this week, we will not bother you. We will not come after you. So we were able to get tenants out by just reminding them of their obligation and that they are still under contract to pay. So you need the experience of the operator as well as the property management company in that location, as well as experience with that type of asset class. So the property management company you would employ to do a Class A asset, which is a newer build within the last 10 years, is very different from the company you would employ for a Class C asset, which is something built in the 70s, because the type of tenants that come there are very different. So you want to make sure the operator has experience in that local market, running a property, as well as the property management company. And that's one way that you can minimize your risk.
Correct. And I think I have a question that somebody reached out to me. Which markets do you recommend? Does anyone want to take that? And I can chime in as well.
The landlord-friendly states, where the landlord always has better rights than the tenants. You want to avoid the East Coast and the West Coast, as Alex mentioned earlier. Some of the really popular markets for multifamily are, of course, Dallas, my favorite place because I've lived here 30 years. But certainly Texas, a lot of parts of Texas are great. Phoenix, Tucson, those are great markets. Atlanta is another popular market, parts of Florida, and then the Carolinas. These are the, I would say, the 5 or 6 most popular markets for multifamily. I certainly know operators who have properties in other states as well, Indiana, Minnesota, et cetera, and they're doing well. So yeah, that would be the most popular markets I know for multifamily investment specifically.
Yeah, I can agree more. I think Texas has been on such a huge run, but I think it's important that do not get emotional. Real estate is also a numbers game. So it is, if you know where to look, you can actually see where migration is, rent collections, how they're doing, and things like that. So for example, like I mentioned earlier, San Francisco, New York, there are lots of people living. Rent is dropping, might not be the best place to invest, but you got to know where do these people moving? Where are they going, right? So we're able to track that information and see, okay, where is Tesla opening new facilities? Where's Apple? Where's Amazon, right? So being able to figure out, because at the end of the day, people do need a place to live. Some of them are able to buy the home and afford that, but some of them are not. They're moving to a new place. They might rent a place. They might stay there for a while. We also follow the trends as far as the millennials. People nowadays typically tend to start their families later in their life, so they're okay with staying in the apartments a little bit longer. There is also a trend where retirees sometimes do downsize even from owning a home, and they're okay renting as well. So we pay attention to all the laws associated, all the trends associated with that, and making sure that we are making the right decisions and recommending to you as a potential investor attractive returns as well. Okay, there is another question about creative finance. T, would you like to read that?
Sure. So Mike asks, creative finance is one of the keys to a successful syndication deals. Will you touch on this? What type of loans, assuming existing loans, refinancing exists, etc., fixed or floating rates, interest only, or amortized?
So I've been looking at properties a lot the last couple of weeks and making LOIs. And I can tell you that one of the biggest things that comes to mind on deals available today is the huge prepayment penalties. Because 2 or 3 years ago, when people bought these properties, they thought they had a great interest rate. And guess what? Now the interest rate is even lower. So today, if I had new financing, the one I would pick is something like a Freddie floater, so that I am not locked into a huge yield maintenance type of prepayment penalty, but then I would cap it. I would pay to cap it so that it doesn't just go excessively high. And then in terms of loan assumptions, yes, those are the most popular deals now because people are trying to get rid of their old deals with huge prepayment penalties. And so you as a buyer will have to raise a lot more capital for it or find some way to get a supplemental loan. So those are the harder deals to sell today. So anyone buying a deal with new financing, I would recommend really look out for that prepayment penalty. Interest rates are super low. They're in the range of 3% or less on average. Depending on the type of loan you get, obviously a bridge loan would be a little bit higher. But one of the creative financing ways on those as well is in some cases, when the traditional Fannies and Freddies don't fit, you could get a bridge loan and then do a bridge to HUD type of financing in 2 years, return much of the capital back to your investors or to your sponsors themselves so that you have that cash available to go on to another investment. So yeah, that's the short answer I have.
Yeah, the interest rates are so low, if I could just add that. So you see a lot of activity in the commercial space. It is not unusual to have a bidding war. Sandhya can probably tell you that, how many properties she has lost over the last several months. The interest rates are so low because of the Fed, right? The Fed has lowered the interest rates and trying to keep the economy fluid, right? So people spend more money, there's acquisition involved, and there is definitely an opportunistic time right now. I mean, let's face it, the banks pay almost nothing, right? What are we earning nowadays in a savings account? 0.23 or under 1%, definitely, right? So we're able to get some of the historically low rates under 3%, which is unheard of nowadays, right? Now, you still have to do a lot of due diligence in terms of making sure that the business plan can be executed and sold a particular asset in 3 to 5 years. You don't want to stuck having that property for longer than that, because ultimately the interest rates will go up. It cannot stay that long forever, right? So we do know that. Now, sometimes what we're able to do is, with our partners, we're able to lock 10-year fixed loans under 3%. That gives us a lot of time, a lot of room to operate and execute on a business plan. So if it takes 3, maybe 5 years, we're still okay, because we're able to lock a 10-year fixed loan. Sometimes we're able to lock even interest-only loan. That also increases the payout to the investors, right? That's how the cash flow distributions are being generated. A lot of times we're looking for conservative investment in terms of, do we have enough reserves? Do we have enough in the business plan in case there might be some turbulence in terms of the business plan? We're not able to maybe execute that fast enough, right? So we got to make sure that we have enough reserves in the bank to be able to supplement if there is a delay in execution of the business plan. We tend to acquire assets that are high occupancy in the 90s. And we can have a separate discussions as well on the preferences as well.
The only thing I wanted to add to that is
yes,
make
go
sure
ahead,
you know your strategy, because if you're going to exit in 3 to 5 years, make sure your loan, especially these fixed rate 10-year kind of loans, if you decide to exit sooner, that yield maintenance penalty could just kill you.
Correct.
So you're aware of your exit strategy when you choose your loan. That's a big one.
Correct.
So I know 1 hour is probably up, and you know how to contact me if I can answer any other questions for you.
Yes, so thank you so much, everyone who is able to attend. We'll be sharing the recording with you guys. Happy to chat offline and connect with all of you. We're local in the area. If any of you would love to meet up at one point, we will resume and have local meetups at one point, sometime near in the future. Hopefully the pandemic is going to be over soon, but please feel free to reach out to Sandhya, T, me, or Ashish, and we'll be able to provide more resources to you guys.
Thank you, everyone, and have a good evening.
Thank you, everyone.
Thank you.
Bye. Thank you for having me.
Thank you. Bye-bye. Have a good evening.
You too.